Vodafone shares jumped 13% on Friday, closing at 100.10 pence, their highest finish since mid-June. The trigger was a binding agreement announced early in the London session. Xavier Niel's family investment vehicle Vega agreed to buy the entire 16.21% Vodafone stake held by Emirates Telecommunications Group, known as ENA, for £4.4 billion at 112.5 pence per share. That price represents a 15% premium to Thursday's close of 97.76 pence, and it instantly made Niel the largest single shareholder in Britain's biggest mobile operator. The market's first read was straightforward. A sophisticated European telecom operator with 50 million customers and €24 billion in annual revenue has decided Vodafone is undervalued and is betting £4.4 billion on a recovery. But the bottleneck in this story is not whether Niel is right about Vodafone's value. It is which version of Niel the market is pricing in. Vodafone's board described Vega as a committed, long-term shareholder and supportive partner. Niel himself said he does not intend to make a full takeover offer. Yet that is what every governance-light activist says before they request a board seat. The plus 13% close is pricing in the optimistic read. What the pool's two named analysts, Citi and Morgan Stanley, cannot agree on is whether that read survives first contact with Niel's operating history.
The market is treating Niel's arrival as a governance upgrade, a sophisticated European operator choosing to back Vodafone's completed restructuring at a 15% premium. The Tele2 evidence points in a different direction. In 2024, Niel's investment vehicle took a 19.8% stake in the Swedish telecoms firm for $1.3 billion, making him its largest shareholder. Within months, Tele2 announced it was cutting 15% of its workforce. Citi analyst Carl Murdoch-Smith put the implication directly. We believe investors will look to what happened at Tele2 after a Niel investment vehicle became the largest shareholder, such as a 15% workforce reduction plan, as a potential framework of what to expect. That is a named analyst at a named bank explicitly building a Vodafone headcount scenario from a single historical data point. Vega's own spokesperson pushed back, saying the Friday transaction was only a share purchase and there was no governance package attached to the deal, adding that Niel would expect an appropriate level of engagement with the company over time. The conflict between those two readings is precisely what the plus 13% close has not resolved. There is a buried assumption in the bull case that deserves examination. The argument runs, Niel is buying into a restructuring complete story. Italy sold, Spain sold, Vodafone 3 merger done, German underperformance the remaining drag, so his role is to endorse the strategy rather than redirect it. That assumption logically requires Niel to be satisfied with the pace of Germany's improvement. His track record, at Tele2, at EAR in Ireland, at Millicom across Latin America, is a record of entering underperforming operators and then accelerating cost reduction rather than waiting for management's current timeline. Vodafone management has flagged results at the upper end of fiscal 2026 guidance, alongside anticipated growth in fiscal 2027. That is a forward-looking management statement. Whether Niel shares the same timeline for Germany is not in any article today, and that gap is where the stock's risk and opportunity both live.
Vodafone's underperformance in Germany is the single most cited variable in every analyst note in the pool. Morgan Stanley explicitly flagged that market focus will shift to Vodafone's German business unit following Niel's arrival. Deutsche Telekom holds the market-leading position there, and Vodafone Germany has lagged in both broadband net additions and mobile revenue growth. That detail matters because it identifies the specific operational lever Niel could pull. His pattern, at Tele2 in Sweden, at EAR in Ireland, is not random cost-cutting. It is headcount and overhead reduction in the subsidiary where the margin gap against the local leader is widest. Germany is exactly that subsidiary in Vodafone's portfolio today. Vodafone completed two major structural moves before this deal: the Vodafone 3 merger in the UK and the agreement to buy CK Hutchinson's 49% stake in the UK joint venture for £4.3 billion. Those moves consumed management bandwidth and justify the restructuring complete framing the board has promoted. But neither move addresses Germany directly. The restructuring Niel is buying into is a UK-first story. Whether he applies the same patience to a German underperformance that UK-centric management has so far treated as a medium-term fix is an open question the articles do not answer. The resolution is one governance event, Niel's first formal request for Vodafone board representation. The Vega spokesperson confirmed no board seat is part of today's deal, but the City note explicitly flagged that investors will be interested to see what level of board representation is requested by Mr. Niel. That request, when it comes, converts the ambiguity into a declared intent, activist, or anchor. For holders, the entry point here is one of Vodafone's most positive governance signals in years, but the position carries undisclosed operational risk if Niel moves on Germany before the current management plan matures. The condition that makes this a confirmed re-rating is Niel accepting a non-executive minority role without pushing an accelerated cost program in Germany. The condition that makes it a trap is a board seat request accompanied by a specific restructuring target at Vodafone Germany, mirroring the sequence at Tele2. Watch for regulatory approval timelines first, and then any statement from Niel about operational engagement before year-end. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.